Welcome to this explainer. Today, we're going to completely demystify the dramatic origins, the unique mechanics, and the market performance of a digital asset that honestly, it just doesn't fit your typical cryptocurrency mold. We're looking at the UNUSSED LEO token. Whether you're an active trader or just kind of curious about exchange-backed assets, this is an absolutely fascinating case study in crypto economics. Let's get right into it.
So, LEO officially hit the crypto scene back on May 20th, 2019. And the name? It actually comes from an ancient Latin fable, translating roughly to one but a lion. The moral there is all about focusing on quality over quantity. And that's a theme that iFinex, the parent company of the huge crypto exchange Bitfinex, wanted to bake right into the DNA of this new token. But as we're going to see, birthing this lion wasn't just some philosophical branding exercise.
Oh no, this launch was born out of sheer necessity and a massive, massive financial crisis. Right before the token was created, iFinex was dealt a catastrophic blow. They lost access to an astounding $850 million when funds held by their payment processor, Crypto Capital, were literally seized by the government. We're not talking about a minor accounting error here. This was a gaping $850 million hole in their balance sheet, and they had to plug it immediately just to ensure the survival and the trust of the entire Bitfinex exchange.
Following that devastating seizure, iFinex went into absolute overdrive. They created the LEO token in May 2019 and ran a private sale to raise that desperately needed capital. And get this, they didn't just meet their goal. They successfully raised a staggering $1 billion in literally just 10 days. 10 days! It's honestly a huge testament to the sheer scale of capital floating around in the crypto markets, and frankly the existing user base's willingness to back the exchange when its back was against the wall.
Section 1. The deflationary engine. The mechanics of a soft floor.
First and foremost, you've got to understand that LEO functions as a strict utility token designed specifically for the Bitfinex ecosystem. So, for active traders on the platform, holding LEO isn't just about crossing your fingers and hoping the price goes up. It provides immediate, tangible value. If you hold LEO in your account, boom, you get significant discounts on your trading fees. You get reduced lending fees. You even get lower withdrawal costs. Basically, it heavily incentivizes traders to buy and hold the asset simply because it drastically cuts down their daily cost of doing business.
Now, while those fee discounts are great, the real engine driving LEO is its deflationary burn mechanism. Basically, this is a continuous process where the creator is constantly buying back tokens from the open market and then permanently destroying them. Poof, gone. This perpetually shrinks the total supply by sending those tokens to a totally inaccessible wallet address. It creates this really fascinating supply and demand dynamic that heavily influences the asset's market behavior.
And the absolutely crucial point here is the massive scale at which Bitfinex is doing this. Every single month, iFinex commits to taking at least 27% of its gross revenues to buy back LEO tokens and burn them. Just think about that for a second. More than a quarter of the gross revenue from a highly profitable, top-tier global crypto exchange is aggressively sweeping the market month in and month out just to permanently reduce the supply of LEO. It's a huge operation.
And the results of that ongoing commitment? Well, they're pretty massive. Out of the original 1 billion tokens minted during that crazy 10-day frenzy back in 2019, roughly 80 million have already been completely removed from existence. So that leaves us with about 920 million in circulation today. Now, as this supply steadily shrinks, the baseline price pressure theoretically moves upward, assuming demand holds steady, of course. In the crypto space, utility tokens with aggressive burn mechanisms like this often create what analysts like to call a soft floor for the price. It basically acts as a buffer against total market collapse.
Okay, moving on to Section 2, the 2025 Performance Tracker, a retrospective on stability.
Looking closely at the numbers here, it's clear LEO's trajectory is anchored tightly to Bitfinex's actual operational success, way more than just random market hype. During the 2025 peak, sure, LEO capitalized on the broader bull runs, hitting highs around $10, up to maybe $10.39. But you know what's really telling? The floor. Even when the market took severe hits, LEO held its ground incredibly well. It rarely dipped below that $8 to $9 range for any extended period. And moving into mid-2026, it's still trading strong right in that $9.50 to $10.35 zone. It acted like a stable harbor. Because it has such low volatility, you aren't getting those crazy 10x moonshot gains, but it efficiently protects your capital while still offering all that great fee utility.
That low volatility stability, combined with that relentless buy pressure, has completely cemented LEO's status in the broader market. Today,
It consistently ranks right up there in the top 15 cryptocurrencies globally, boasting a massive market cap that hovers around 9.5 and sometimes up to $10.3 billion. It really is a financial heavyweight, just kind of hiding in plain sight.
Which brings us to Section 3, the case for Leo versus the hidden risks, weighing the anatomy of an asset.
So the bullish case for Leo is pretty straightforward. It relies on that guaranteed buy pressure from the monthly token burn, which, again, is backed by real revenue from a very profitable exchange. You've got measurable, real-world utility saving active traders cold hard cash, and historically, it gives you low relative volatility, which means shallower drawdowns during those brutal crypto winters. But we definitely have to acknowledge the hidden risks. The glaring concern here is ecosystem centralization. Leo's value is literally 100% tied to the success, legality, and reputation of Bitfinex and iFedEx. If Bitfinex starts losing market share, Leo's utility drops, period. Then there's the regulatory side. iFedEx has definitely been a target for legal probes in the past, and any severe action against them could crater the token's value practically overnight. Plus, since it's an exchange utility token, your upside is limited. You are highly unlikely to see the sort of explosive meteoric gains you might get from, say, emerging AI tokens or a brand new Layer 1 blockchain.
All right, Section 4, the final verdict. Defensive play or high-risk corporate bet?
Ultimately, our verdict is that UNSZ Leo is a moderate-risk defensive asset. It serves a highly specific purpose. Look, if you're an active trader on Bitfinex, holding this token is a total no-brainer, just for the fee discounts alone. It's fantastic for operational savings. But for the average investor who isn't trading on Bitfinex, well, you really need to understand exactly what it is you're holding. You are essentially making a direct, concentrated bet on the sustained revenue and corporate success of one specific centralized company.
Which leaves us with this final, honestly kind of paradoxical question to ponder as we wrap up the explainer today. In an industry fundamentally built from the ground up on the promise of decentralization, trustless networks, and peer-to-peer finance, could one of your safest portfolio defenses actually be a highly centralized corporate token? It's a really fascinating contradiction, and it definitely makes UNSC Leo one of the most uniquely positioned assets in the entire crypto space right now.
Thank you for watching this video. Please subscribe this channel.